Hello, hello. This is Chris Q, your host for Cash Flow Hacks podcast. And today I'm so excited to have Michael. Michael, thank you so much for joining Cash Flow Hacks podcast. I'm so thrilled that you were able to join us. And for those of you who are listening, Michael Wade here works with a company that we have collaborated with to help our clients keep more of their money. We are always talking about helping our clients make more. But not only do we help them make more, we want them to keep more of it. And one of the ways we do that is by using different type of investments that help our clients do that. And this taxes is one of the biggest enemies of wealth. And that is one of the things that you have been able to help us with is a tax incentivized opportunity. So before we go over that, before we get started, do you mind sharing with us a bit about you and how you even got into this?
It's very interesting. It was not the first thing I invested in. I'm actually from Nashville, Tennessee, the home of country music and healthcare. A lot of people don't realize that Nashville is actually a healthcare city. So there's music and healthcare. So family owned a home healthcare company. It was private duty. It was cash basis. So I grew up in the healthcare. From the time I was 6 years old, cashing nurses' checks. That was my favorite thing on Fridays, go to the family business and help cash and get the money to the nurses. So I just grew up in healthcare. After graduating college, went to Belmont and worked in a healthcare company. So healthcare was pretty much my entire life until I started investing. And from the investments, I started with healthcare IT, a little bit of real estate, got into commodity imports, podcast companies, and just every year I would find something new to invest in or something new to get involved with. One of the things at Belmont University when I was there, they did these things called convocations. And as a college student, you're like, it's one extra thing. I don't want to do it. But looking back, it was probably one of the most fascinating things. I got to listen to this guy, John Polkinghorne, was a physicist, studied under Albert Einstein from Cambridge, flew in and spoke, and so this was, 15, 20 years ago. The opportunity for podcasting and the ability to have information actually delivered to you, just like we're doing today, was unheard of. You'd have radio and you'd have a few people or maybe some guest speakers, but to pay or to be in a room with intellectual thinkers and people sharing information and collaborating, it was special. That's what it eventually got me to the podcasting realm and loving podcasts because the access to information. So yeah, it wasn't until from the Nashville area, healthcare IT, moved to Florida for a few years. Florida's a completely different ecosystem. It wasn't until I moved to Texas, the land of energy, that I started seeing energy deals. It was about 2 years living in Texas when I made my first investment in energy.
In energy, and I love the way you say that, energy, because let's talk about energy. What does energy mean to you?
Well, you're talking to a Bitcoiner here, so I have a really fascinating love for energy. Back in 2016, participated with, this was pre-Coinbase, pre-exchanges. It was a group of us. We just kind of went together to start learning about cryptocurrency. The proof of work concepts. Energy is the foundation of civilization. So if you look at third world countries, they're going to use the amount of energy that we may use in a refrigerator for 1 year. And they would love to have energy abundance. And so we take it almost, it's commonplace. Like we flip on a light switch and energy comes on. We open the refrigerator and things are cold. But for many people across the world, that's still not quite the case. And a lot of people don't realize even with energy, oil and gas, the byproducts, everything's made with oil and gas. So from oil itself, petroleum based, I was talking to a doctor friend. I said, okay, with petroleum itself, everyone in medicine's used to generics or alternatives. What's the alternative to petroleum? There is no alternatives. Petroleum is petroleum. Now, there's the synthetics they try to make, but it doesn't replicate exactly all the different product uses. Natural gas, there's a byproduct for natural gas, which is fertilizer. A lot of people don't realize fertilizers are made as a byproduct of natural gas. So the farming industry is dependent just as much on the natural gas resources for the world. And so energy was really fascinating to me. It's one of those things when you jump into the industry, you realize really quickly you can be in this space for 40 years and you're still learning something new. And so for myself, I want, they started out with all the carbon credits, and they started coming in with this ability to say, hey, if you use too much energy, we're going to penalize you if you use this type of energy. And my thesis personally is energy abundance. So I believe if we used our resources naturally, I'm not saying solar and wind are the best yet, but it's a start. But it may just not be placed in the best locations. If you're sitting in New Zealand and you're off the ocean, you have excess breeze, great. Texas is a great place because we do have breeze. We do have a lot of wind and solar. We also have a lot of oil and natural gas. It's a lot of use cases.
I have some friends that I grew up with when I was a kid, and they have been working on like using their land. And
yes,
finally, after all these years, finally got the contract. And they're in New Mexico.
Yeah. And the problem we have with the windmills and stuff is recycling the resources that go into making those. So we're still not there. So really energy, I think, when you think of technology, and I love technology. I'm a huge nerd, a huge techie. Everybody's in FinTech, MarTech, you start naming them. And I believe energy tech is kind of one of those places that I found really fascinating. So a lot of people don't realize that, and I'll forgive me, I don't have the exact quote in front of me, but there's 2,000 independent operating companies in the United States. Most people, when you think energy, you think BP, Exxon, you think these big players, but most of the energy that's created in the U.S. comes from small companies. It's still small business America. So there's 2,000 independent operating companies, average employees, 12 people or less. And I want to say they make 80% of oil and 90% of natural gas in the U.S. So that's not the refinery and making it, but it's actually the production comes from a small business.
Well, why don't you share a bit about the opportunity that we're able to share with our clients? Like, explain how that works and like what kind of returns people are getting and like the tax incentive.
Well, let me tell you first what happened. So I sold a few real estate properties. So it was residential properties in early part of 2022. And when I sold those, I didn't use a 1031. So you use qualified intermediaries to do 1031. So I just kind of sat on it for a little bit. And then I had this offering here that I took to my CPA and I said, here's the PPM. They're telling me I get this tax deduction. Yeah, I just had a lot of capital gains. Have you seen this before? He literally looked at me. He's been my CPA for 12 years at this point. He goes, oh yeah, I've seen a few of these. So why haven't you told me about it? He goes, well, I'm your CPA. I go, but you're also my friend. I was like, you don't have to tell me what to do, but just that this tool exists.
Right.
And so as we talk about this today, I hope if everyone here is like, I hope is the intention of what you get out of this, that this tool, this strategy exists. It's real. And if it's useful, use it, and so I'm not telling you exactly what to invest in, but the strategy itself.
I'm all about them. It's like the government actually gives us an incentive to do certain things.
Yes. This is an old tax code. So it was in the early 1900s. I think it was 1912 or 1913 when this tax code was written into law. But to get into the high level, so the way that this works is that it's a working interest into a pro rata partnership. And all that means is that you're buying working interest into a portfolio. And so what the portfolio will do is they'll go out and acquire, develop, and divest properties. So what that looks like on a very high level, and I want to kind of zoom out, if anyone's been entertained an oil and gas deal before, traditionally oil and gas companies would acquire what's called a land lease. So it's the right to develop a property. And within that land lease, you'd have to negotiate just like real estate. You have to look at the title. You have to look at the property. So everything that would go into like land development with a property, you still have to do that within the oil and gas operating companies. And also the royalties. So there's surface rights, mineral rights. You have to make sure that everything's verified first. And traditionally, oil and gas operators would go out and they would acquire this land lease and they would go to an investor and say, hey, Mr. Investor, I want to put 5 wells in this property. Would you invest? Those are called wellbore assignments or wellbore investments. So you're investing in the well itself. And so what can happen is, oil and gas is risky. You could have 1 of 5 wells not produce. You could have 2 of 5. You could instantly, maybe have a downside. If you're looking at your downside risk, 20, 40% if 1 of the 2 wells don't hit. And so there was a bad rap kind of in the oil and gas industry. That was the traditional model. So the model that I found was you actually get to participate and sit on the same side of the partnership as the operator. So instead of just investing in the wells or a package of wells, this portfolio, it includes the land lease, all the projects, all the wells. So it's asset backed, which is what I liked. So that was one of the big benefits of this. And it was brand new. The model was completely flipped. It's really similar to real estate development. It's newer and a portfolio strategy that was implemented in 2015 at the company.
Well, can you tell us, like, if a client were to invest some of their money, especially for the tax incentive, let's talk about what kind of tax incentive? What does that even mean?
Yeah. So the U.S. likes to incentivize energy production. And to do that, there is this tax benefit. Now, the unique thing here if anyone's familiar with real estate, you're familiar with either active or passive losses. So you as a real estate investor, you have to have a certain amount of hours, or you have to be working in the industry to receive the active losses. Otherwise, it's going to be passive. The unique thing about the oil and gas is, especially it's still early in the year, we like to tell everybody 75 to 80%. If you're talking to your CPA for kind of a tax strategy early in the year, for every 100,000, you can deduct 75 to 80,000 accelerated in year one. Now, we can go over. Now, like last year was 86%, the year before was 89%. But at the same time, that's not always going to be the case, because it's also dependent on what how much capital is deployed. And so we tell everyone to be safe 75 to 80, as you're looking. And that's full adjusted gross income. That's anything that you have active income. That's just not passive income. And that's a big benefit, especially to high income W-2 earners. High income W-2 earners, there's not a lot of options for them on the market. Yes, you can do some IRA, some Roth, you can kind of have some deductions, but as you start looking at strategies, this will all kind of defer to you. What options are there on the market? Conservation easements are beginning to go away. What strategies out there? And that's one tool that I think they can bring to the table, saying, hey, maybe my portfolio, I haven't invested in oil and gas, or I haven't invested in energy yet. I'd like to look at that.
Well, it's definitely something that we have been able to use with our clients that want to lower their tax, that they're paying. There are a lot. And I need to do some more podcasts on some of these different strategies. But the oil and the gas is just, it actually is, I've been investing in it to lower my adjusted gross income. I mean, there's no other place that you're able to take that much, at least that I know of. I mean, we do have other opportunities that we can help our clients with, but this is just another way to be able to do that.
Yes. Yeah. And so the tax deduction is great. And so that's step one. And so the way that the oil and gas works, I'm gonna kind of resemble it to real estate, because a lot of people know real estate. So let's say you have a house and then you need to go get a permit to put in a pool. The same thing happens in oil and gas. It's just because you have the land doesn't mean you just start developing wells anywhere you want. So you actually have to go and permit the wells. And that takes time. So from the very beginning, if you're going to, let's say, just for using this fund for an example, when you start raising capital, it could be 9 months to a year before you see your first paycheck, your first dividend. And so that's all the time that it takes to acquire the land. And then you have to build out a drilling plan. So they actually just within the land acquisition itself, they look at what's called 3D subseismic. So there's teams that come out. There's different ways they can see what's up under the earth. And so those are called probable reserves. So you look at the land, you look at the value, and you acquire the land lease. You get all the title, talk to all the royalty owners. And when I say royalty owners, one property just in East Texas, 2,000 acres can have 200 royalty owners. So it's not just like overnight you can have everything wrapped up. Like there's full land teams that this is all they do, that their entire job is for title, royalties, and making sure that the land is exactly what you have. And then you have the drilling teams that come in. So it takes time for the title and land, and then it takes time to put a drilling strategy together. And that could take a few months. And then you have to get the drilling teams out there. You could do shallow wells, a week, 2 weeks, 3 weeks. You could have long horizontals. When we say horizontal, that means you drill down. Let's say you drill down a mile in the earth and you drill out laterally. You go 2 miles. I've heard of some 3, 4, 5 miles laterally. And that takes a long time, because if you have a drill bit, just like a drill your house, and you're drilling through hard rock and you're down a mile and you're out, say half a mile, the drill bit wears out, pull it all the way back up, replace the drill bit, start again. There's a time and a process. So for this strategy itself, we tell everyone 8 to 10% annualized, and that's actually going to be the oil and gas sales. Now, those are cyclical, and those are also based on the price of oil and gas. Now, they can be higher or lower than 8 to 10%, but for example, 2 years ago, gas was at $9. So when you're selling per unit, you sell at $9. Historically, it's 5 to 7. Well, today, if you go look on the market, that same gas is being sold for like $1.80. So there's a big price discrepancy from where it was 2 years ago to where it is now. Now, when prices are higher, you can also, some of the drilling costs can be a little bit more. So when the oil and gas kind of went back down, drilling cost was less. So there's also that operational balance. Do you go now and deploy your teams now with the land and the property and the money? Or do you wait just a little bit until price and then you can drill later? So there's even some wells that we had when gas was at 9 that we started. It was we called with drilled uncompleted. There were gas wells. When gas started falling, we drilled the wells. We didn't complete them, and we're just now starting to turn those back online with the anticipation that gas will probably rise in the next 3 to 6 months. So there's also a timing mechanism to it. What's really unique in this portfolio strategy is that there's actually a return of multiple and exit, the probability for a multiple and exit. So if you have well bore, like I said previously, you just own the wells. If you have the land lease and you're the owner of the land lease in that portfolio, as you drill wells on the property, imagine like a cake up under the earth. So there's different layers. So the first stage when you're doing what's called exploration development, I call it the science or the testing phase. So let's say there's 5 layers up under the earth. You don't want to go out and spend $500 million just drilling to try to figure it out. So the drilling team, petrochemical engineers, geologists, everybody gets together and they build strategies to say, we want to prove each zone. So zone 1, 2, 3, and there's different names for them. The formations would be a wolf camp, church. I mean, you can go through all kinds of different.
I've seen all of that. I'm a picture kind of person. I like to have a visual. And
yes.
I like that you guys have shared that with us. One of the things that I like about working with your company also is that you guys use different, it's almost like, I'm going to call it a mutual fund, but it's not a mutual fund. But I like why do people buy mutual funds? People buy mutual funds because they figure, if one's doing good, whatever, they're not going to lose it, if one's going up, one's going down. And your structure, the way you guys have it set up, can you talk about that a little bit?
Yeah. So there's different projects within the portfolio. So there's currently over 80,000 mineral acres in the portfolio. So there's 20,000 acres in Texas. There's some in Wyoming. There's different projects in different states, even a small property in Colorado. So there's diversification, just like you would have kind of wells within different zones. So we can do wells on different zones and different wells in different areas. And so there's different drill teams for different areas. So as the operator, think of us more like the GC of a project. I like to, again, related to real estate. It makes it simple to understand. If you were in real estate and you acquired land, you probably have a company like JLL or some of the big builders come in and build a big building for you. Same thing in this industry. There's different geologists that are specialized at different rock types and different drill teams. If you had a drill team in Texas and a drill team in Pennsylvania, they're going to have different terrains, different rock types, and they're going to have different specialties. So the same thing that we use as the company is we have different drill teams in different areas and asset managers that specialize in the rock, the geo, and the terrain to not only drill, but to perform the analysis for that area.
Well, I know that for you, most of this has been all pretty high level.
Yes.
But for some of our listeners, it may sound, like a little over their head. And, I want everybody to kind of understand, like I own an electric car. And people say, why in the world would you invest in oil and gas? Well, oil and gas isn't going anywhere anytime soon. I mean, there's no way for it to disappear. So I realize that there's a lot of money in it. And I don't feel like it's.
Report that ERCOT just put out a few days ago that showed the amount of electricity usage that's going to be needed by 2030. Mm-hmm. And it's up and to the right because it's not just the electrification of vehicles, which will be powered by all kinds of different energy types. But then you also have AI. AI and the need for energy because AI is compute, GPU compute. So that need in and of itself is going to be a whole nother purchaser of energy that's coming in to the ball game where you have AWS and, QTS data centers, all these different companies that are building out data centers that still to this day the need for energy is an ever growing need. And that'll also put demand on the current energy resources and infrastructure we have in the U.S.
It's not going anywhere.
It's not going anywhere.
Not in our lifetime, probably.
No, I don't think so.
So I have a gas vehicle also. But yeah. I really like taking care of the earth and, taking care of the land and not causing more harm to the earth than we need to. So how would you talk to people that are on that side of the, if this is, because a lot don't want to invest because they feel like it's wrong to help destroy the earth. Is there something you'd have to add to that?
Well, I think it depends on how they're coming about it, because there's a lot of misconceptions within the oil and gas space. Yes, there's always something that could happen, but that's one of the things with that energy abundance thesis. I think that we need people in this space to get the thought at the forefront, in the front of everyone's minds, because there's clean tech that's coming out, even with oil and gas, like the ability for them to drill and to use less resources and less energy than they would have before, or more waste. There's less waste than before, and so it's funny kind of that counterbalance when I say, hey, everyone thinks clean energy with windmills and with solar, but where do you dispose and recycle? There's recycling facilities and just landfills of materials that are still sitting there. The energy that's created and the materials that are created, even from a Tesla or an electric battery, there's a lot of materials, cobalt, lithium. Those are mined. And have you seen those facilities and work the mines themselves? They're dangerous. They're reactive. Within oil and gas, there's a need and a solution. And I think it's also with that balance of how much energy is used. And I love that people are conscious of the energy usage, but at the same time, allowing people to come in the space and bringing the ideas and innovation, that's going to allow us to create that energy abundance where we now have new uses where we can. Transportation itself is 20% of the oil and gas bucket. A lot of people think, oh, it's a full pitcher, but it's only a small use of the entire pitcher that oil and gas actually uses. And so I think everyone's well aware and conscious of it. I think there's been a driving need for it, but I would say at the same time, the ESG mandates they put in, they're starting to retract a lot of them because I think what they thought would be a good thing wasn't quite the measurable outcome that they were hoping for. So I think there's still a lot of need in the market.
I've read a lot of those studies, but can you give us an example? If someone were to invest $100,000, could you kind of walk through I think this will be one of the easiest ways for people to understand. Could you walk me through that tax break, how that would work?
Yeah. So for $100,000, it would be 75 to 80% in the first year. It's 100% deductible over, the 5-year period, but you can accelerate year one, 75 to 80%. And then as oil and gas comes online, you'll have the 8 to 10% dividends. And those every month, they'll sell oil and gas. They're an upstream company. So they sell to what's called the midstream. There's a 30 to 45 day revenue cycle. So for all the product, the oil and gas that's sold in March or April, let's say April because it's April, there's be 2 months. So everything's sold in April, May, June. June is when you get paid for all the April production. And then after the properties are developed within that 3 to 5 year window, they'll package them up and they'll start the divestiture. And the divestiture is based on the production plus, and those are all the wells that are drilled. And then just as if you were to build a residential neighborhood, and let's say you have phase 1 and 2 done, and there's 3, 4, 5, 6 left. Same thing in the oil and gas space. There's what's called proven undeveloped wells. So areas within a location that have not been developed but could be developed. Those are what they call them PUDs. People will pay a premium for those. So they'll buy the acreage. And so that's where you get your multiple and exit. So 75 to 80% deduction year one, 8 to 10% annualized returns on average forecasted, and a multiple and exit.
A multiple on exit.
Yes.
So it's kind of, and like in the beginning, it's kind of like the bonus depreciation that people are familiar with real estate. So what is your plan for oil and gas? Are you going to still keep investing in oil and gas for the next 20 years?
I was going to say, I don't think any of us could look out 10, 15, 20 years. But I would say for right now, you have the SPR. And for those who don't know what the SPR is, Strategic Petroleum Reserve. And so those are basically these large reserves the U.S. have. We've been using those to offset the price of oil and gas. So in the interim, we've been using our supply, which should be reserved for wartime, and we've been draining those. And there's actually a recent announcement that the government may use some additional reserves to keep the artificial price of oil and gas a little bit lower. So we've been using reserves. We've been restricting the supply or the operators by all these ESG mandates. A lot of publicly traded companies, they're not going to drill new. So I think we're in a good place personally for myself. I think over the next 3 to 5 years, we're in a great place where there's the supply and demand metrics there that I just simply look at. Now, if the U.S. opens wide, the federal properties and really starts subsidizing oil and gas, I think, 10 years out, that could change. But I think the mechanics right now are a pretty good setup personally that I see for a good investment for myself.
Yes, I agree for myself. And for a lot of our clients, this has been a great way for them to mitigate their taxes. But just to finish this podcast off, I just want to like reiterate just with kind of some numbers. So somebody puts in $100,000. The first year, basically, they can choose to be, if I remember as I did this, it's like I could choose to be a limited partner or a general partner, right? And so as a general partner, I am able to take
75 to 80% deduction in the first year of investment.
Explain to people what that means. What does that mean exactly?
So there's an intangible drilling cost.
How is it going to help I want you to like give a number. Like, how does that look for them? So if they give you 100,000, basically they can basically take $75,000 off of their gross income, right?
That's correct. Yes. $75,000 to $80,000 for every 100,000 they invest.
Okay. And then also they're going to be receiving a paycheck monthly.
Yes.
Okay. These are smaller checks because they're just getting started, right?
That's correct.
The goal is to get them up to, I know when we first started, what can you tell me?
I mean, my personal check got as high as percent annualized returns, and that was when oil and gas prices were higher. So it's variable. And right now it's, I think 4% was last month's production based on the current number of wells that are drilled with more coming online. So that's depending on production and oil and gas prices.
So for me, I kind of like wasn't really expecting to get anything at all. So it's sort of like a little cherry on the top for me. And then, I'm getting this nice tax deduction. Now I'm getting a little bit of money, take my family out to dinner every month, right? Get this little check. And then also there's one more thing. What is it?
The multiple on exit.
Yes. Can you tell me my 100,000, how much is the multiple on exit? I mean, I know we don't know exactly, but it is predicted or hopeful that we're going to have an exit of what?
Yeah. So we're about 80%, I'd say 75, 80% of the way done with capital raise for the fund. The CFO just redid and took out a lot of the theoretical numbers. When you first start a portfolio, so we said, hey, we want to have a goal of 3.5x. And so what we did is now that we're about 80% of capital raise done, we haven't deployed all the capital, but we've started raising. A lot of people are saying, hey, where are we today? And today there's a chart there, but I would say it's about 1.5 to 2x, give or take. If we were to sell the assets and what has to happen and occur for the mechanics is that the first part of the fund, let's just say for simplicity, we'll split it in half. The first half was for land acquisition development. So the land's there. We have 80,000 plus mineral acres. Now that we've gotten a few of the strategies proven on that property, the next phase is to get a joint venture company to come in and partner with us. So we spend $30 million. Sometimes, I know it's very expensive for just the 3D subseismic. So there's other operators, they don't want to spend all the money for the land, but they want to come drill. So that's the next phase of this project is they need to come drill. And so until this contracts are signed and everything's in movement, CFO want to just be very transparent and say, hey, here's where we are today. And so it's, about a 1.5x, maybe 2x on the absolute high. And that's also oil and gas price dependent as well.
And so what does that look like when you're telling somebody that? I'm trying to make this like super, super simple.
Yes.
My $100,000 on exit with the 1.5. What does that mean?
If we were 1.5, you would have capital back of 150,000. If we return at 2x, you'd have a total return of 200,000 for every 100,000 you put in. So
basically, I would get my $100,000 back, plus I would make 100,000 and a half.
Yes,
150,000. So that, I just wanted to make it super simple for people, because there might be some people out there that are interested, but they look a lot of information. It really is.
It's definitely new. A lot of people haven't invested in the energy space yet. And it's risky. Oil and gas is inherently risky. I think anyone tells you that, they're lying to you, because everything from, the wells themselves, there's 96 vendors for a well. There's wells that you drill and some of them don't produce. They may produce a little bit, but not commercially economic viable where you'd say, hey, I would redeploy that strategy. But that's part of the testing phase before some of the other drillers come in and really develop out. And there's, so it's finding a product and a tax strategy and a company that you feel comfortable with, an operator you feel confident with, and a strategy that fits you and your tax needs as well.
So did you ever work for any other oil companies?
I have not worked for another oil and gas company. I have not.
Why did you come to this one? What was it that drew you to this one?
some of the tech innovation. So a lot of the smaller operators are, I don't want to say it's archaic in a way, but what's worked for them has worked for them for many generations. It's how their grandparents did the business, how their aunts and uncles. One of the things that really drew me in here was the innovative approach, not only just in portfolio strategy, but I actually got to dive in a little bit with rebuilding some of the systems, working on some of the data. So there's a lot of data within oil and gas. There's public and private, rebuilding some of the data centers with some of the teams and really being innovative forward was really some of the neat things that I liked about and the reason why I kind of partnered in.
Well, we are glad that you did, and we're so glad that you joined us today. So thank you so much. And Michael, we'll be talking soon.
Thank you.